Ray Dalio is one of the most well-known figures in the investing world, and with good reason. The hedge fund billionaire is perhaps most well-known for his data-driven approach to investing that has helped Bridgewater, the firm that he founded, become one of the most successful investing firms in the world. And while a lot of the strategies that his firm has pursued are not available to most regular investors, Dalio has discussed an investing strategy that regular Joes like you and me can participate in, the all-weather portfolio. It is perhaps the most well-known investing strategy whose primary goal is to perform reasonably well in a wide variety of economic conditions, from rising and falling growth to inflationary surprises. The all-weather portfolio, or at least the all-seasons variant that us regular investors can actually fully implement for ourselves, has you split up your investments into 5 different assets. 30% of your money goes towards a total stock market fund, 40% of your money goes towards long-term bonds, 15% of your money goes towards intermediate-term bonds, and 7.5% of your money goes towards commodities and gold. Stocks are there because they tend to do well in environments of rising growth, or inflation that's lower than expected. Bonds are meant to cover you during periods of lower than expected economic growth or inflation, while commodities and gold tend to do best when inflation is surprising to the upside. With that being said, let's examine if the all-weather portfolio manages to achieve its goals of producing solid returns regardless of economic circumstance, to see if it deserves its reputation as the premier risk-parity investing strategy. As usual, we'll start by analyzing the strategy's historical returns.
But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to the investing platform M1 Finance. Get started investing for free today.
To analyze the returns, we'll be looking at several different metrics. The short and long-term inflation-adjusted returns for every possible starting year for which I have available data on all the assets, in this case that's since 1970, the risk-adjusted returns, how often the portfolio loses money on an inflation-adjusted basis, and how severe those losses were, how dependable the strategy is based on how sensitive those long-term returns are to when you decide to start investing, and of course, how often the portfolio manages to hit our specified return targets. So based on the data that I have since 1970, the average 40-year inflation-adjusted return for the all-weather portfolio is about 5.9%. Its best and worst case return was around 6.3% per year and 5.2% per year. That suggests that a $10,000 investment would grow to an inflation-adjusted $99,000 over that time frame on average. At worst, you're looking at a nest egg of around $75,900 and at best $115,100. In any given year, the returns have been as high as 25% and as low as negative 12%. On average, the single-year returns hovered around 5.6%. The Sharpe and Sortino ratios for this strategy were 0.59 and 1.06 respectively. That's the best Sharpe and third best Sortino ratio among the strategies we've covered so far, suggesting that it has been one of the best allocations on a risk-adjusted basis during these years. Next, let's look at some volatility metrics. The average standard deviation of returns for the all-weather approach was 8.5%, which means that in any given year, we can expect that most of our returns will fall somewhere between negative 2.9% and 14.1% with this strategy. The approach had an excess kurtosis value of negative 2.79, suggesting that the majority of its returns were in fact within a few standard deviations of our average. Roughly 73% of the returns during these years fell within our expected range, and only 7 of them fell outside the range for the worse. The strategy had a skewness of 0.37, suggesting that the majority of its returns would actually be below the long-term average, with a few returns coming in significantly above that average to drag it up, which is different than most of the strategies we've covered so far in this series. As far as losses go, there were a total of 14 years, out of a possible 52, where the portfolio failed to keep pace with inflation in this sample. That's a loss frequency of around 27%. Of those losses, 3 fell by at least 10% and none by at least 20%. And of course, most of these downturns were recovered from relatively quickly, as there wasn't a single 10-year stretch where the strategy failed to keep pace with inflation, though it did come close between 1972 and 82, earning just 0.1% per year above inflation during that period. Next, let's talk about start date sensitivity. Start date sensitivity, at least as we're measuring it in this series, takes a look at the rolling returns of the 10 years prior to each initial investment date and compares it to the rolling returns of the following 10 years to see how big of a difference there is between the two. It's a good way to get an idea of how dependable or trustworthy an investing strategy has been historically, and ideally, we want to keep our total start date sensitivity, measured here by the difference between the largest underperforming and largest overperforming decades, as low as possible. The all-weather portfolio had a total start date sensitivity of about 14.7% during this time frame. The largest overperformance was 10.3%, which took place from 1982 to 1992. In those years, the all-weather strategy had an inflation-adjusted return of 10.4% per year, beating out the returns from 1972 to 1982 of 0.1% a year. The largest underperformance was negative 4.4%, when the returns from 1999 to 2009 failed to match those produced from 1989 to 1999. On average, its start date sensitivity hovered around 2.6%, and it managed to earn at least an inflation-adjusted 6% per year in 33% of all 10-year stretches. But that just about wraps up our analysis of the strategy's returns. Now, let's move on to our crash analysis. A crash analysis is important to do for any investing strategy you're looking at because it's important to know that if you're going to be putting your life savings into something, that you'll be able to weather the storms when they come, financially and otherwise. In these videos, we look at several different metrics when analyzing the crashes. They are the depth of the crashes, how long it took for the portfolio to bottom out, how much the strategy rose and fell relative to the rest of the market, how much of its time was spent in either crash or correction territory, how strong and sustainable its rebounds were, how long it took for the strategy to set new all-time highs after falling, and the Ulcer Index, which seeks to give investors a better idea of what the investing experience will be like by considering the depth and duration of downturns. For the all-weather portfolio, the deepest inflation-adjusted crash took place from 1980 to 1982, when it trailed inflation by just 14% at its worst. And keep in mind that inflation rose by about 20% during that time, so if you had actually been invested in this portfolio during those years, you still would have technically, on a nominal basis, made money. It just wasn't quite enough to keep up with inflation during that 2-year span. Its longest downturn took place from 1973 to 75 during the oil crisis, when it trailed inflation by as much as 11%. Other notable downturns like the dot-com crash and Great Recession were not too far behind, lasting for 2 years each, but in both cases they only fell by about 3%. Yeah, you heard that right, 3%. The average downturn saw the all-weather portfolio fall just 5.7% from previous highs, with a downside deviation of 3.4%, suggesting the majority of downturns would see drops between 2.3% and 9.1% once they've bottomed out. On average, it takes around 3 to 4 months for the portfolio to bottom out. This gives it a dive rate, or the amount that the portfolio would fall in an average downturn if it had continued falling at the same rate for a full year, of about 19%, which is incredibly low. In the year immediately after bottoming out, the all-weather portfolio had minimum, average, and maximum rebound intensities of 2.8%, 11.4%, and 25.6%. To get an idea of its longer-term resiliency, we can look at what I call the portfolio's comeback magnitude, which measures how much the portfolio grows each year on average between bottoming out and setting new all-time highs. In this case, the all-weather portfolio's comeback magnitude was 5%. On average, it took a little over 1 year and 2 months for the all-weather portfolio to set new all-time highs after bottoming out. This means that on average, downturns lasted roughly 1 year and 6 months. It spent 4% of its time in correction territory and none of its time in crash territory. And its downside capture ratio, which measures how far the portfolio falls relative to a benchmark in the months where the portfolio itself is down, was 62 when measured against the total stock market, suggesting that when this portfolio falls, it does so significantly less than the market as a whole. However, when the portfolio was rising, it was also doing so at a slower rate than the overall market, scoring an upside capture ratio of just over 29, suggesting that its strong downside protection was not quite enough to make up for its lackluster upside performance relative to the overall stock market. As far as the investing experience goes, the portfolio had an Ulcer Index as high as 0.5 during these years, though on average it hovered around 0.1. With that being said, let's move on to examining the strategy in regards to financial independence. Historically speaking, the all-weather strategy would have maintained minimum 30, 40, and 50-year safe withdrawal rates of 4.88%, 4.50%, and 4.29% during this time period. The worst year to retire using this strategy was 1970, as that's when all these minimums were set. I should note that as usual, due to the varying nature of individual expense ratios and tax situations, neither has been considered in these withdrawal rates. The median rates were 7.12%, 5.72%, and 4.97% for the 30, 40, and 50-year scenarios, respectively. And the maximum rates for the same durations were 9.35%, set in 1983, 7.40%, set in 1982, and 5.04%, set in 1971. The strategy would have maintained a minimum perpetual withdrawal rate of 3.98%. And as usual for this series, I'm defining perpetual withdrawal rate as the highest withdrawal rate that you could have had while still maintaining your original inflation-adjusted principal all the way through to the end of the dataset. In terms of income during financial independence, the all-weather portfolio generated an inflation-adjusted average of roughly $70,000 per year on a $1 million nest egg among all available 30-year cycles. The accumulation phase of financial independence is where you're still putting money away for your future. The primary metrics here are what percentage of our income are we saving, how do our expenses change over time, how long do we plan to be retired, and how long will it take us to reach financial independence based on that information and the performance of our investing strategy. Assuming that we saved 15% of our income, we're planning for a 30-year retirement, and our expenses change changed in line with inflation as measured by the CPI, we would not yet have achieved financial independence. However, with a 30% savings rate, we would have reached our goal in 19 of the 52 scenarios. On average, it would have took about 40 years to reach financial independence at this level of savings, with the fastest and slowest paths taking 32 and 51 years respectively. With a 50% savings rate, a hypothetical investor would have reached financial independence in 37 of the 52 scenarios. On average, it took about 18 years to do so, with the fastest and slowest paths taking 15 and 28 years respectively. And finally, with an absolutely crazy 70% savings rate, the numbers improve even further, with a hypothetical investor reaching financial independence in 45 of the 52 scenarios. On average, it took about 8 years to reach financial independence at this level of savings, with the fastest and slowest paths being 6 and 16 years respectively. The last metric I like to check under the financial independence banner is the strategy's scalability. When I say scalability, I'm referring to the strategy's ability to scale up or increase its minimum safe withdrawal rates and/or FI income metrics when we incorporate drawdown maximization techniques such as cash buffers, financial guardrails, and flexible spending budgets. The more scalable a strategy is, the larger the benefit we'll see in these metrics as more and more of these techniques are used. I reran all the simulations for the all-weather portfolio using the assumptions you see on your screen. The upper and lower guardrails are set to 20% above or below the initial safe withdrawal rate. The trigger indicates how far our investments will have to fall below their all-time highs before our cash buffers or flexible spending budgets will be used. The spending floor is the lowest our hypothetical investor will spend in a year regardless of what the financial guardrails tell them to do, unless their investments have fallen below that trigger threshold, in which case they'll live on their survival expenses. Here's how the numbers came out. As you can see, there's a jump across the board for safe withdrawal rates, which also translates into superior accumulation metrics. The income figures improve early on, but as usual, due to the fact that our guardrails would have us slash our incomes more often than before, the overall figures are a step down. Comparing the all-weather portfolio to all other strategies that we've covered so far in this series since 1985, we see that it has some very notable strengths and precious few glaring weaknesses. Its long-term returns are right around middle of the pack, ranking 9th among the 16 strategies we've covered in this series. However, when risk is taken into the equation, it shines, placing 3rd in the Sharpe ratio and 2nd in the Sortino ratio. Its volatility is lower than most other strategies, illustrated by it having the 4th lowest standard deviation at just 6.8% during these years, and it's been about as dependable as it has been consistent, with the 5th best start date sensitivity figures. In terms of tranquility, it's been pretty hard to beat. It trails inflation less than all but 2 other strategies while capping its losses to single digits as well as anything else. It's quite literally never trailed inflation by 10% or more at any point during this time period. Its resiliency is probably where this strategy performs weakest. While it doesn't really have to bounce back very much to fully recover from downturns, since it doesn't fall by very much to begin with, that rebound period following market bottoms has not managed to produce very strong returns relative to most of the other strategies we've covered. That could lead to some greed-inspired and/or rotational-style trades for those who aren't fully settled on this strategy and its merits to begin with, as other approaches often earn double or even triple the returns during that recovery period. Still, since the approach doesn't give much ground during market turbulence, its less than stellar recovery performance does not mean that you're spending a long time waiting to see new all-time highs set. Quite the opposite, in fact, as it's tied for the 4th shortest downturn duration, both on average and in terms of its longest downturn, and is one of the few strategies that did not spend any of its time in either crash or correction territory based on the yearly dataset that I have available to me. So in the end, does the all-weather portfolio accomplish its goals? Well, it depends on how you view it. On the one hand, there's no doubt that it has managed to perform well relative to most other strategies under a very wide variety of economic conditions, and I have no reason to believe that that'll change anytime soon. It's just hard to ignore the fact that the strategy fell just a few percentage points during the Great Recession. That's pretty spectacular all on its own. It's also hard to ignore that compared to most other strategies that have attempted to perform well in a wide variety of economic circumstances, such as Harry Brown's permanent portfolio, the Golden Butterfly, or the Larry portfolio, the all-weather approach has arguably produced the best long-term returns, at least since 1985, though the Golden Butterfly is right there with it. On the other hand, relative to those same strategies, it does seem to give up a little bit in terms of resiliency. All those strategies have managed to avoid falling into crash or correction territory during this time frame, but some have produced stronger performances coming out of market downturns, and as a result are setting new all-time highs quicker, the Golden Butterfly being particularly notable in this area. It also doesn't do quite as much as some other risk parity strategies when it comes to diversifying itself globally, at least explicitly, which is not necessarily a deal breaker, but it is worth noting. So if the question we're trying to answer is whether or not it has been a good strategy to manage one's investment risk, I'd say yeah. It has been, and in all likelihood it will continue to be going forward. But if the question is whether or not it has been the best in that regard, it gets a little tougher to say, and will likely depend on personal preference to some degree. Do you want something with a slightly higher long-term ceiling, even if it means giving up some performance in those, admittedly, relatively rare periods following downturns, as well as potentially giving up some amount of international diversification? Or do you want something that performs a little bit stronger in those situations, even if it means giving up a little bit in terms of long-term returns should things go well? That's a question that really only we can answer for ourselves.
But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.